Now after completing the valuation based on the net asset method with certain adjustments, now we are going to do the valuation based on dividend growth formula. In that case, how we are supposed to do answer? Let us have a discussion of the same. Everybody is requested to pay attention. Giving you first of all explanation about that informally. We have been provided with the amount of the dividend 125 crore. We already have calculated that the number of equity shares are 12.5 crore. So the total amount of the dividend divided by number of shares, that will give dividend per share. So 125 upon 12.5, that comes to 10 rupees per share. That is the dividend per share. Dear students, we understand that say we are required to make the calculation of the cost of equity for the target company using the existing information. We understand that in the existing information, the growth rate is 15%. So what will happen? We'll make the calculation of the D1. It is 10 rupees into 1.15 raised to 1. That comes to 11 rupees 50 paise. That is D1. Based on that, so the cost of equity can be calculated. It is 11 rupees 50 paise divided by P0. Current market price is 75. Plus dividend growth model, dividend growth rate is right now 15%. In a way that's taking into account the existing information, we make the computation of the answer. So 11 rupee 50 paise upon 75, 0.1533 plus 0.15, that comes to 30.33%. That is the way the cost of equity is calculated. We understand that so this cost of equity is going to remain same. Dividend per share is going to remain same. However, the growth rate is different. What is the growth rate now? Under the new management, it will grow at the rate of 18%. At the rate of 18%. So kindly use your calculator. It will be 11 rupees 80 paise. 10 into 1.18. That is what we understand is the D1. Now based on that, so the P0 is calculated. P0 is found as D1 divided by K minus C. What is D1? It is 11 rupees 80 paise divided by what is cost of equity. Cost of equity is 30.33 less growth rate. Growth rate is 18%. So the answer would be 11 rupee 80 paise divided by cost of equity minus growth rate. That comes to 95 rupees 70 paise. Now once you compute the price, based on that, say calculation of the premium is very simple. Minus 75, you'll get the premium. Okay, 75 is the current price. And that can be converted into percentage term. That is the way we can do the premium calculation. So write down heading. Calculation of premium based on dividend growth model. In that write down working note number 1, calculation of D0. D0 stands for just paid dividend. It is total dividend divided by number of shares. The total dividend is 125 crore. Divided by number of shares are 12.5 crore. That comes to 10 rupees per share. That is the way the D0 can be calculated. Next, working note number 2, calculation of cost of equity of SVL. Okay, it is D1 divided by P0 plus growth rate. What is D1? D0 into 1 plus G divided by P0. What is the current market price of the share? It is 75. Plus, what is the growth rate? Growth rate is right now 15%. Okay, the existing growth rate will be considered for the purpose of calculation of the cost of equity of the target company right now. Amount of dividend is 10 into 1.15 divided by 75 plus 0.15. So it is 0.1533 plus 0.15. 0.3033, that is 30.33%. This is the way cost of equity is found. Next, calculation of revised market price of share of SVL. Of course, the dividend growth model. In that case, K is equal to D1 divided by P0 plus C. This is the basic formula. Now this time we are required to find P0. So we are required to rearrange the formula. So it is K minus C is equal to D1 upon P0. So now P0 is equal to D1 upon K minus C. Now how to calculate the D1? D1 is found as D0 into 1 plus G divided by cost of equity. It is 30.33. Less growth rate is 18%. What is D0? D0 is rupees 10 into 1.18 divided by 0.3033 less 0.18. So 0.1233. So the final answer would be like this: 10 into 1.18 divided by 0.1233. That is 95 rupees 70 paise. That is the revised market price of equity share. Now based on this, we can make the computation of the premium. So premium per share is calculated as revised market price of equity share minus current market price of equity share. So it is 95 rupees 70 paise minus 75, 20.70, and as far as the premium in percentage term is concerned, it is 20 rupees 70 paise is the premium over the current market price of 75. That comes to 27.60. That is the way premium in percentage term can be calculated. Now, after making this calculation, the question provides further that ICL means acquiring company will push forward which method during the course of negotiation. So between both of them, which method is to be put forwarded for the purpose of acquisition? That is a question. Now we have already calculated the premium by using method number 1 and method number 2. As far as the premium is concerned, it is 27.60% for method number 2 and premium is 49.35% for method number 1. Now these are the two different methods that we have for the premium calculation. Now the question says that between both of them, which method acquiring company will put forward for the purpose of acquisition? Dear students, over here the answer which have been provided in the suggested answer, in that they have recommended the second method for the reason that the acquiring company is required to pay less premium. That is what's the answer which they have provided. I want to tell you something more than this, that this is a question basically which has been taken from a reference book called I.M. Pandey's reference book. From that the reference book, this question has been taken, and the answer which have been provided in this reference book of I.M. Pandey sir, in that he has also given the answer that we should put forward the second method. However, the reason that he has given is that the financial management is more about the futuristic. It is more about considering the time value of money, considering the risk aspect rather than the accounting. Because you can see that the first method is going with the accounting concept, wherein you have calculated the net assets, wherein you have calculated the revaluation of the land and building, you have calculated the profit, but you have taken the average profit. So they have recommended the second method, but the reasoning is different. So this is the way the answer is supposed to be given. Right on answer. Right on answer. ICL is advised to offer method number 2 because in that method premium payable is comparatively less. I just revised the second method. Premium based on the dividend discount model approach or dividend growth model approach. In that, first of all, we make the calculation of the just paid dividend. The just paid dividend is rupees 10 per share. Then we make the calculation of the KE, cost of equity of the target company, that is D1 divided by P0 plus Z, that is 30.33%. Then we compute the revised market price of the equity share of the target company using, so the new growth rate, which is 18% in this example. Of course, the price is supposed to be higher. It is more by like 20 rupees 70 paise, that is the price by which it is higher. So that is the premium that you are going to offer. The premium in percentage term is 27.60. That premium is lower than the method number 1. So method number 2 is suggested. However, as I told you that this question is from a reference book called I. M. Pandey reference book, wherein author has suggested the method number 2 with a different reason, that the financial management is more about the future perspective. It takes into account the risk, that is the cost of capital. It takes into account the dividend policy, which is reflected in the dividend. It takes into account the rate of earning of the company, which is included in the growth rate. So these are the aspects to be considered for the purpose of valuation.